Hello, I'm Liz Lumley of Finextra, and today I'm speaking to Anna Mazzone of Thomson Reuters, and we're going to talk about KYC, Know Your Customer, which is, of course, a huge topic in the industry right at the moment. So what are some of the wide-ranging issues affecting KYC in the market right now?
It is a big issue for the financial markets right now on a global scale. I mean, the biggest things that are facing them is the unprecedented level of risk that the market's exposed to right now as a result of money launderers, financing associated with terrorist activities, as well as fraudsters that are using the internet for illegal activities.
So it's real serious stuff, you know, that we're talking about with KYC.
Oh, absolutely. The internet gives the clients the ability to do business anywhere these days. And really, another issue that's starting to come out as part of KYC is the fact that governments are trying to hold on to their tax revenue. So you see regulations such as FATCA, the Foreign Account Tax Compliance Act, which was implemented by the U.S. IRS services. And so now we see 30 other countries starting to implement their own FATCA type solutions. So you've got tax issues. Since 9/11, there's just been unprecedented focus on terrorist financing. So that's created more regulation coming out, and which is facing the financial institutions today around identifying politically exposed persons, sanction regimes, you know, just doing more focused, targeted efforts around identifying money laundering. In addition to that, because of the financial crisis, the markets have, or I should say clients, the industry has basically looked at the regulators and said, you didn't do a very good job of regulating the financial institutions during that period. And so thus you see Basel III, which has created higher requirements around capital adequacy. So thus now what's starting to happen is banks are having to really look at their activities that they're doing and looking at where can we take cost out of our business, particularly things that don't give us a competitive advantage. And there's a lot of activity associated with doing KYC reviews on clients. And so that's an area that the markets globally are evaluating. How can we do this better?
So Anna, given the regulatory environment that you just laid out earlier, you know, in terms of KYC, what are some of the challenges that the market is facing?
Yeah, it's a really interesting question, Liz, because the challenges are associated with a lack of standards when conducting client due diligence on the customers. That lack of standards has led to the fact that business is slowing down. Clients are telling us, when I talk about that, I mean buy-side corporate clients of financial institutions, they're telling us it's taking them anywhere from 3 to 6 months to open accounts and do business around the world. And so you've got that factor of the regulation, the increased regulation. The other point is the fact that the buy-side is also being asked more and more by their investors. They want to understand what is their compliance governance within their firm. So what are they doing to ensure they understand where the sources of funds are coming from, you know, investing in the firm. And then you've got the fact that also the clients of the financial institutions are having to supply more and more documentation, a lot of it private information such as passport data. And this data is being transmitted via email, which is a very unsecure medium, and these clients are starting to become concerned about identity theft.
Yeah, understandably so.
Yeah, absolutely. And so you've got that. And then the final thing is that, you know, we're not talking about just collecting articles of incorporation or prospectus or actually screening clients for PEPs, you know, politically exposed persons or sanctions. The fact is that also, you know, you've got to start now collecting tax documents from across many jurisdictions. And the bank systems just aren't capable of doing this. They aren't capable of handling all these, you know, different sources of information coming in to create one file on a legal entity. It takes a huge amount of investment. And it's kind of investment that doesn't really give them a competitive advantage. So it goes back to, you know, something I talked about earlier, which is the fact that under Basel III, these firms are trying to take cost out of the business. You know, investing here in this KYC, which is a regulatory requirement, doesn't really drive the top line, right? So thus, these are the challenges facing banks in terms of they're trying to figure out what's a more efficient way, more effective way for me to be able to comply, but at the same time, not slow down the ability for us to do business, and also ensure that the client experience is very positive when interacting with my financial institution.
So how is the market really addressing some of these challenges then?
So financial institutions are beginning to realize that doing KYC really well doesn't give them a competitive advantage. That is a requirement in order to be in the financial markets, right? However, what they're also realizing is that they can come together and create what we call utilities or shared managed services in order to take cost out of their business and more efficiently serve their customers, and at the same time meet the regulatory demands regarding KYC. So what's the difference between a utility and a managed service?
Yeah, that's what I was going to ask as well.
Yeah, they're very different. So utilities are, I kind of describe them as really vanilla offerings in terms of the fact that they collect documents, they collect data, and that's it, and they distribute it out to, you know, a group of parties that are supposed to, you know, have been permissioned to have access to that information. Shared managed services is more around, yes, they exchange that information, the documents and data, with the financial institutions, but they also add value to that information by either screening data, they look for corporate actions events, they collect tax documents, things will get wrapped in kind of using e-signature technology so the financial institution can feel much more comfortable with the information they're obtaining, et cetera. So the difference really is managed services is just added value as opposed to the utilities of vanilla offering.